President Cyril Ramaphosa is looking to strike a deal with his U.S. counterpart, Donald Trump. This forms part of Pretoria's efforts to reset its relationship with Washington, which has so far shunned diplomatic efforts. SA has been in the line of fire of Trump's America First policy since he took office in January. He has signed an executive order halting U.S. funding to SA, and Trump's 10% tariffs on all Chinese imports, along with the looming 25% tariffs on the U.S.'s main trading partners, are expected to affect SA too. Ramaphosa told investors at a Goldman Sachs event that a deal of one sort of or another needs to be made on trade issues, on diplomatic issues, and on political issues. Cabinet approved the Medium-Term Development Program. The plan, which covers 2024 to 2029, outlines key priorities for the government. It aims to, amongst others, ensure inclusive economic growth, reduce unemployment, poverty, and the rising cost of living. The draft targets a GDP growth of 2 to just over 5% by 2029. And that is based on the assumption that over the next 5 years, the government will implement accelerated reforms while addressing infrastructure and fiscal pressures. Cabinet has appointed acting SAA CEO John Lamola as permanent CEO of the state-owned airline, but the move has come under harsh criticism. The DA urged the Cabinet not to appoint Lamola, who, according to a News 24 media report, ranked lowest in competency assessments. The party alleges Lamola was appointed because of his political affiliation and has reported Transport Minister Barbara Creasy to the Public Protector for undue political interference in the appointment process. Low metal prices continue to weigh on Impala Platinum. The world's second largest producer of platinum group metals has posted a 43% slump in half-year profit. Given this, the miner has decided to forego a payout to shareholders. Impala also withheld its interim dividend last year. Truworths' first half profits came in nearly 5% lower amid a sales slowdown in its African markets. It's also cited a gross profit margin decline on that end. Truworths says its Office UK segment, meanwhile, continued its impressive trading performance, driven by its successful store modernization and expansion program. The group's declared a dividend of 317 cents, which is 4.5% lower than the prior period. Motor says its half-year results are a tale of two quarters. In the first 3 months, the automotive business battled a slowdown in the economies in which it operates. But in the second quarter, business confidence improved, interest rates were lowered, and the two-pot retirement system was introduced in South Africa, all of which helped consumer sentiment. This helped to support a 3% increase in interim headline earnings per share. A dividend of 240 cents has been declared. This reflects an increase of 2% on the previous period's payout. CAP has posted a profit knock. The Diversified Industrial Group's interim headline earnings per share fell 21%. That's as the firm's operating and finance costs rose due to the ramp-up of PG Bison's MDF line, and lower domestic new vehicle assembly volumes also weighed. But CAP anticipates that the impact of both those factors will start easing in the second half as the MDF line starts to be used and vehicle assembly volumes improve. MTN has warned of an earnings slide. Africa's largest mobile operator has forecast a fall in annual headline earnings per share of between 59 and 79%. The firm has highlighted the negative impact of local currency devaluations, particularly the Naira, as a reason for this. It also pointed to operational challenges in Sudan due to conflict in the country. MTN will release its financial results on the 17th of March. Sanlam's eyeing higher year-end profit. The financial services group expects its headline earnings per share to rise by at least 30%. Sanlam says it's recorded excellent underlying organic growth, with all lines of business posting strong performances for the financial year. It's posted to higher investment returns on the shareholder capital portfolio in 2024. coupled with reduced project expenses. And the group cited lower external financing costs related to the broad-based Black Economic Empowerment Special Purpose Vehicle. Harmony Gold expects to produce glittering half-year results. The yellow metal miner says headline earnings per share could be as much as 50% higher. That's due to a higher bullion price during the period. Harmony will open its books on the 4th of March. Apologies for that. Meanwhile, Japan's Seven & I Holdings said the retailer's founding in terms of family could not secure the financing required for a $58 billion management buyout, and it would consider a rival offer from Canada's alimentation couche-tard. Let's take a look.
7-Eleven stores could get a new owner after all. Japanese parent firm Seven & I Holdings says the retailer's founding family can't secure the funding for a management buyout. Trading house Itochu, which owns rival convenience store Family Mart, said it had decided against taking part in the deal, valued at $58 billion. Now 7 & I says it will again consider all other options. That includes a takeover offer from Canada's Alimentation Couche-Tard, the operator of Circle K stores. It saw a $47 billion bid for the Japanese firm rejected last year. But now analysts say it looks to have a higher chance of pulling off the mammoth takeover. If it goes through, that would mark the largest ever buyout of a Japanese firm by an overseas company. It would also make the combined firm by far the largest convenience store chain in the US, a fact likely to attract the attention of competition watchdogs. Market watchers say the bid is one of the most prominent examples of a surge of interest in Japanese assets. They look more attractive after the country finally exited deflation. Corporate governance reforms have also drawn more investors to a market once seen as virtually untouchable for foreigners. Shares in 7 & I plunged Thursday following news of the failed family buyout. They closed down by almost 12% in Tokyo trade.